Today's market reaction wasn't just about relief. It reflected how quickly investor expectations can flip when a major source of uncertainty suddenly eases. What we saw was a powerful, broad-based rally across U.S. equities. The major indices all moved sharply higher, led by technology, while volatility dropped significantly and the U.S. dollar weakened. At the same time, bond yields moved lower, suggesting that some of the inflation pressure tied to energy may be easing. But the most dramatic move came from commodities. Oil collapsed sharply, reversing last week's spike, while gold held steady, an unusual combination that already hints at a more complex underlying signal. That brings us to what actually changed. The key driver was geopolitical. A sudden de-escalation in tensions around the Strait of Hormuz, reinforced by a temporary ceasefire framework, forced markets to reassess a worst-case scenario that had been rapidly priced in just days earlier. Investors had been preparing for a potential disruption to global energy supply. That assumption drove oil higher, volatility higher, and pushed capital into defensive positioning. Today, that narrative reversed. Instead of pricing in escalation, markets began pricing in stabilization, or at least a pause. And when that happens, the reaction tends to be fast and aggressive. You could see that clearly in how capital moved. This wasn't just buying, it was repositioning. Institutional money rotated back into cyclical and growth-sensitive areas. Industrials, materials, and technology all saw strong inflows. Consumer discretionary stocks also performed well, reflecting expectations of lower input costs and improved demand conditions if energy prices remain contained. At the same time, the areas that had benefited from fear, particularly energy, were sold off aggressively as those hedges were unwound. Volatility collapsing and the dollar weakening reinforced that shift. Financial conditions, at least temporarily, became easier. But beneath that surface strength, there are still some important fragilities. One key risk is that markets may be focusing too much on the reopening of shipping routes and not enough on the physical side of energy supply. Even if geopolitical tensions ease, production and storage constraints in key regions could still create disruptions. In other words, the risk hasn't disappeared, it may have just shifted form. There's also the question of how durable this de-escalation really is, because if the ceasefire proves temporary or fragile, the same risks that were aggressively priced out today could return just as quickly. And this leads into the broader macro signal. What today's move suggests is not necessarily a confirmed shift in trend, but rather a rapid repricing of one specific risk: energy disruption. Lower oil prices ease inflation concerns at the margin, which helps support equities and brings yields down. But at the same time, gold holding firm suggests that some level of underlying caution remains. So the market is sending a mixed message. Relief, yes, but not full confidence. An interesting question investors are debating right now is whether this kind of rally reflects a genuine improvement in the macro outlook or simply a temporary unwind of extreme positioning. I'd be curious how you see it. Is this the start of a more durable recovery in risk appetite, or just a short-term reaction to one headline? Looking ahead, the next phase will likely depend on a few key variables. First, whether the ceasefire holds and leads to a more stable energy supply outlook. Second, how quickly lower energy prices feed into inflation data and central bank expectations. And third, whether any signs of stress begin to emerge elsewhere, particularly in credit markets or financial conditions. Because if those areas begin to tighten again, today's relief could prove short-lived. The broader takeaway from today's market reaction is that positioning, not just fundamentals, is driving a significant part of price action right now. Markets had leaned heavily into a risk-off scenario, and today forced a rapid unwind of that view. But the underlying environment still carries uncertainty, so while sentiment improved, conviction remains fragile. If you enjoy this kind of calm, analytical breakdown of market behavior, consider subscribing. I share regular briefings focused on the deeper forces shaping global markets. And as always, thank you for taking the time to be here.